Apple just announced that Tim Cook is stepping down as CEO, with John Ternus taking over in September. And this is all happening just before earnings on April 30th, which could mark a turning point for the stock. So the real question is, what is it actually worth going into a leadership transition like this? Under Cook's leadership, Apple has grown from a market capitalization of approximately $350 billion to $4 trillion, representing a more than 1,000% increase, and yearly revenue has nearly quadrupled from $108 billion in fiscal year 2011 to more than $416 billion in fiscal year 2025. So there's really no question, Tim Cook has done an exceptional job leading Apple. But now, the company is entering a new chapter, and for investors, that's where things get interesting. Because when a company like Apple goes through a leadership transition, the question isn't what it did in the past. It's how you value what comes next. Right now, Apple is a $4 trillion company. Over the past 5 years, the stock has outperformed the S&P 500 by more than 30%. And if you zoom out to 10 years, that outperformance is closer to 700%. So if you invested in Apple a decade ago, you made a lot of money. But that's not the question anymore. The question is, after a run like this, with a $4 trillion valuation and a leadership transition ahead, what are you actually buying today? Going forward, one of the biggest constraints for Apple is growth. The numbers analysts are projecting for Apple are solid but not spectacular. Revenue is expected to grow around 9.7% over the next 2 years. EPS forward growth comes in at 12.2%, and the long-term EPS growth estimate is 11.8%. For most companies, those would be excellent numbers. For a $4 trillion company trading at 34 times earnings, they are respectable, but they only hold up if the underlying AI strategy actually delivers. And that's where the CapEx chart becomes uncomfortable. While Meta grew its capital expenditure by over 158%, Microsoft doubled its infrastructure spending, and Amazon ramped up nearly 75%, Apple went the other direction, cutting CapEx by 18.4% over the same period. Every other Mag 7 company is treating AI infrastructure as the most important investment of the decade. Apple is treating it as something they can largely skip. Their argument is on-device AI. Intelligence built into the chip, processed locally, no need for massive data center build-out. It's a genuine differentiator, and the M and A series silicon makes it technically credible. But the real-world results have not supported the theory yet. Siri still underperforms. Apple Intelligence launched without conviction, and Apple is licensing Google's Gemini to cover the gaps, which is hard to reconcile with a company that's supposed to own its entire stack. The story here is straightforward. Apple is projecting double-digit growth while spending less on the technology that's supposed to drive it. That either makes them the smartest capital allocator in the Mag 7, or the most exposed when the AI era fully arrives. Now, when you look at profitability, this is where Apple really starts to look like a premium quality business. Gross margin is at 47.3%, operating margin at 32.4%, net profit margin at 27.0%, free cash flow margin at 28.3%, and operating cash flow to sales at 31.1%. Across the board, these are exceptionally high numbers. And more importantly, they haven't been stagnating. These margins have been trending steadily upward over time, meaning the business is not just high quality, it's still improving. And when you look at return on invested capital, it becomes even more striking. Apple is currently generating ROIC of 48.68%, and since 2021 it has consistently stayed above 40%. So when you put all of this together, it's hard to argue against the fact that this is a very high-quality business, and one that arguably deserves a premium valuation in the market. Now the question is whether that premium is actually reasonable today. When you look at the valuation multiples, price to earnings, price to operating cash flow, and price to free cash flow, all of them are trending gradually higher over time. In other words, over the last decade, Apple has consistently re-rated to a higher multiple environment. Over the past 10 years, the average PE multiple has been around 24.7. Today, it stands at approximately 34.6. That's a meaningful expansion, especially for a company that is generally expected to grow only in the low double digits going forward. So even if you accept the argument that this is a very high-quality business, the valuation today starts to look more stretched relative to history. And this is not just a PE story. Price to operating cash flow and price to free cash flow are also significantly above their 10-year averages. If you then look at forward valuation, you see a similar picture. Forward PE is around 31 versus a long-term average closer to 22.8. And again, both price to operating cash flow and price to free cash flow remain meaningfully above their historical averages. So across every major valuation metric, the same pattern shows up. A business that is undeniably high quality, but also trading at a clear premium to its own history. Now, if we move from valuation to capital returns, there's another important layer to this story. Over the last 10 years, Apple has reduced its share count by roughly 45%, which is why it's often referred to as a buyback machine. In more recent years, the pace has normalized slightly, but the company is still consistently buying back around 2% of its shares annually. So what you're looking at is a business that not only generates strong cash flow, but also systematically returns a large portion of that capital back to shareholders. Now we move into a DCF framework with a set of conservative assumptions behind it. What you can see on the screen are 3 scenarios. In each case, revenue growth starts in the low double digits in year 1, but gradually normalizes into high single digits over time, converging toward long-term terminal growth levels. Under this setup, my discounted cash flow model produces a weighted target price of around $205 per share, which implies roughly a 24.5% downside from current levels. In other words, the DCF is suggesting that Apple looks overvalued at today's price. If we then switch to an EV/EBITDA exit multiple approach, the framework assumes a 25x multiple in the base case, 28x in the bull case, and 22x in the bear case. Even under those assumptions, the model produces a 5-year weighted target price of around $308 per share, which translates to roughly a 2.5% compound annual return from current levels. So across both valuation methodologies, the conclusion is broadly the same. There is no meaningful upside from current levels. And the reason for that is not weak business quality, but rather conservative growth assumptions combined with already elevated valuation multiples. Building on that, we can now run a sensitivity analysis to stress test the assumptions. In this framework, I'm assuming PE multiples of 25, 30, and 35 across the bear, base, and bull cases. For earnings growth, I'm using 12% in the base case, 10% in the bear case, and 14% in the bull case. The model also assumes a required return of at least 15% CAGR, with a 10% margin of safety applied. Under these assumptions, the implied entry price comes out to around $188, which is below the intrinsic value derived from my DCF model, but broadly in the same range once the margin of safety is applied. However, when you translate this into returns, the picture is not particularly attractive. Even in the bull case, the expected return is only around 14% from current levels, while in the base and bear cases it is lower than that. So overall, the sensitivity analysis reinforces the same conclusion. Even under reasonably optimistic assumptions, the upside is limited relative to the risk. Now, if we assume a scenario where the price were to decline by around 25% from current levels, down to roughly $200 per share, the return profile starts to look meaningfully different. At that entry point, assuming 12% earnings growth, which is broadly in line with long-term expectations, and a 30x PE multiple, the implied return would be around 16% CAGR. If the market were to re-rate the multiple higher, for example to 36x, the return profile improves further, reaching approximately 20% compound annual growth. Even in a scenario where the multiple compresses to the 26 to 28x range, returns still remain in the strong double-digit territory, slightly above market levels. So at those lower levels closer to $200 per share, Apple starts to become a much more attractive and asymmetric investment opportunity. So when you put everything together, from growth and profitability to valuation and capital returns, there's no question that Apple is a high-quality business. The fundamentals are strong, the cash generation is exceptional, and the long-term track record speaks for itself. However, going forward, the picture becomes more uncertain. A leadership transition with a new CEO, more conservative growth expectations, and a relatively elevated market multiple all combine to create a less attractive setup from current levels, based on my assumptions. That doesn't change the quality of the business, but it does change the risk-reward. And that's why at today's price, I personally don't see it as an attractive investment opportunity. This is currently a hold rating for me. If you found this analysis useful, make sure to like the video and subscribe for more deep dive financial breakdowns like this.